Hi there! If you are tuning into this podcast, it means one of two things. Either you have no clue about managing your finances or you want to take them to the next level. Either way, we've got you covered. Financially Ever After is for the modern day Indian professional who is ready to take control of their financial journey. So let's start building your financial future one episode at a time. Welcome to Financially Ever After.
हो गया 1 सेकेंड गो लाइव
Hmm.
इसको करो ना उस पर मेरे को अंदर लेके आओ कॉल में
तुम्हारे पास तो है मास्टर, तुम ही तो रखे हो।
तो यू हैव टू रेज अ हैंड और समथिंग ना
तुम एक्सेप्ट नहीं किया था, तुमने
किया था मैंने
ज्वाइन किया मैंने।
कोई आया नहीं है सो ओके ठीक है लेट्स स्टार्ट ओके
Okay.
Hi everyone and welcome to today's episode on the very basics of investing in mutual funds. So let me quickly introduce myself. I am Medha, one of the founders of WealthUp,
And hi guys, I'm Ankit, another founder of WealthUp, and today we are following a different format wherein we are both joining from the same account.
yeah, so basically what we wanted to do was have a very back to the basics conversations about investing. And why did I choose mutual fund? We'll cover like more about mutual funds later, but Ankit and I really believe that if you're a beginner to investing, which means you have never invested before, this is the first time you want to take this plunge, then it makes sense to start with mutual funds. So this is also a recommendation that if you don't know how to do research, if you're very new to this, then it makes sense to start with mutual funds, right?
Right.
Okay, so Ankit, let's talk about mindset, right? Before even getting into the tactical stuff, what is the right mindset to have when it comes to investing?
See, first of all, before that, before you actually get to investing, getting into the mindset that you should be investing, right? So when people start, making money very early on, they're not even, many times they are like, it is the first time they have had so much money and they want to spend it all and do so many things that they have never done. Which is totally fine if you want to enjoy for a few months, you can definitely do that. But after that, you need to start saving, because sooner or later there will be bigger things that you would like to do for which you will need money, be it higher education, be it buying a car, being going for a travel, be it buying a house or whatever it is, or again, fire is something that is becoming very common. So planning for your fire, whatever it is, you need money for all of these. So and you need to get into the practice of planning towards that. And the very first step is of course saving. Once you have started saving, you need to start putting money so that the money starts working for you. And when it comes to investing is a more structured approach. It's not that you're doing something very random and कि हाँ ठीक है हो जाएगा sort of. That is not how it is supposed to be. And if you're trying things out, कि just investing some money in some stocks, crypto, those are more speculation, just कि let's see कि what कि क्या होता है. ठीक है, it's not more कि it's not called, it can't be called investing. Getting into that investing mindset कि taking a structured approach कि हाँ I'm actually working towards something.
Okay, so then let's talk about how investing starts, right? Like I've decided I want to invest. So now what is the next step? And I have savings, I've saved up some money, or I've decided ki salary mein se, whatever 30-40,000 I'm going to invest. So what is the next step?
Next step is key. First of all, you should have that emergency fund, as we talk about. Once you have that in place, then understand ki what is it that you're saving towards, right?
Investing towards.
Ki if it is short term, long term, understanding yourself, your risk profile, and once those things are in place, you need to see ki what kind of investment you can make, right? And because whatever investment you are making, whatever asset classes you are choosing, those have very unique characteristics, and they should work for you. It shouldn't start working against you. So you need to know that very well before you start putting your money, because again, this is your hard earned money. You can't be cavalarious, with it.
ठीक है. So basically, if you're a complete beginner to investing, the way to get started, first you decide how much money you want to invest. You understand what your financial goals are, which we have talked about in previous sessions. Includes, okay, what is the amount of money that I need, when do I need it, and then you understand your risk profile, right? Do you like to take a lot of risk, take less risk, etc. And with those basic things, at least you have an understanding of how to get started. Now the next thing comes to, okay, mutual funds, right? Like I said at the beginning of the session, sorry, actually, yeah, we should talk about asset classes. But what I wanted to say, Ankit, was that before you actually get starting to invest in anything, invest in any mutual fund, it's important to understand what are mutual funds, right? So which brings us to asset classes. So Ankit, if you can talk about what are the different asset classes.
So few of the very common asset classes that exist is, first of all, of course, equity or shares, a part ownership in the company. Okay, this is, of course, when you're buying individual shares, those are riskier compared to mutual fund because diversification is not there, and you need to do a lot of research to understand, what is a good company, what price to buy at, what price to sell at. So this is what an equity is, and you become a part owner in the company. You do get voting rights, and if the company is distributing any dividend, that dividend comes to your account. So you're actually a part owner of a company. That is what equity is. If the share price goes up, down, you will have direct impact of it. Next one is debt. Now, debt is not something that the Indians have actually become very accustomed to what that means. Debt is essentially loan. So we all know what is it about taking a loan, but generally speaking, we have not given a loan in a structured manner. I mean, we might have lent money to our relatives or friends occasionally, few of us, but in a more structured manner, giving that money to someone, lending that money to someone so that you're earning an interest. Okay, that is what debt is. In like very simple terms, fixed deposit is also a debt, because you have given that money to bank for a fixed amount of whatever period, and you are getting 7%, 6.5%, 7.5%, whatever the interest is, you are getting that. So that is what debt is. It's a fixed income return, fixed income instrument. Apart from that, gold is there, which all of us understand what gold is, and that is another asset class, and real estate is another one. Now, why? And apart from these, there are a number of other asset classes which we won't get into. That is like for more advanced people, anyways. But why are these asset classes different, or why are they categorized as different asset classes? Is because their characteristic is different. How do they behave in certain situation is going to be different, and that is why they are categorized as different asset classes.
Yes. So on an asset class level, you have equity, you have debt, and you have gold. Now, one thing
Real
is that
estate.
and real estate. But what I was getting to was that when it comes to mutual fund, you can invest in all of these things through a mutual fund. So when we talk about equity, and Ankit said it's investing in stocks, right? You can either do it directly, which is you decide and buy stocks of a company, or you can do it through mutual fund. Similarly, if you want to buy gold, you can go out and buy physical gold, which we don't suggest. But when it comes to buying digitally, you can also do that through mutual fund. So first, just understanding that essentially a mutual fund is a way of investing in various type of asset classes, right?
So mutual fund in itself is not an asset class. It's not an investment in itself. It is just a way of investing. There is just a channel.
Okay, perfect. So Ankit, if you can just talk to us about what is a mutual fund then.
Sure. So, okay. So one option, suppose I have 10 lakh rupees and I want to invest. One option is if I know how to do a research, okay, this, and suppose I want to put this money in equity. So, okay, I do my research and I find, okay, Reliance is a good company to invest in. Now, the next question is, what is a good price to invest in Reliance? And then what is a good price to sell that share? If I am someone who has the skill set as well as the time to do this, follow this, I can definitely get into that, do it myself. But if I'm not an expert or I don't have the time, I just give this money to someone who is an expert. I mean, traditionally speaking, many times what used to happen is that there is someone, we know, be it a CA, be it someone in the family who knows how to buy, sell shares. We give that money to that person. Ki, "ठीक है, you can invest on my behalf. Here is 2
Yeah.
lakh rupees, 5 lakh rupees.
Yeah.
You can invest on my behalf." Just think about it from a more structured manner. Instead of giving it to someone like that in your family or acquaintance, you're giving this money to someone who's an actual expert and working according to proper regulations and with all the infrastructure and everything. So thousands and lakhs of people like you and me, like small investors who are going to put in few lakhs or few crores of money, who are going to invest relatively small amount of money, they give this money to an expert who's a portfolio manager of a mutual fund, and they take this decision on our behalf. They manage thousands of crores for lakhs of investors, and they take this decision where to put that money, when to put it, when to sell it, what price to buy at, what price to sell at, and they are doing this decision work for us full time, and this is their full time job. So they completely dedicate their work towards this.
So, Ankit, what is the benefit of investing in mutual funds? One is obviously that...
First of all, you don't invest in mutual fund. You invest via mutual fund.
Okay, yes, thank you for correcting that. You invest via a mutual fund because mutual fund in itself is not an investment.
Yeah.
Yes.
So you give money to this portfolio manager, and based on the mandate, based on the kind of fund you have chosen, this money will be invested either in equity or debt or gold or real estate or a combination of this, as per the whatever the investment philosophy and terms of this particular fund is. Okay. Now, Medha, you asked me about the benefits.
Yeah.
So first of all, the benefit is it is managed by a professional. Okay, so he's an expert. He knows when to buy, when to sell, and he's actually sitting in the market, doing that research, following the market very closely, so that this decision can be taken. Okay. Apart from that, when you're investing in mutual fund, even if you're investing a very small amount of money, 5,000 rupees or even lesser than that, no matter how much money you're investing, you are already your funds are getting diversified. Suppose if I want to buy, shares of Reliance, and I have in total 10,000 rupees, I can only buy 3 shares of Reliance. Okay, and that's it. And even if suppose I buy just 1 share of Reliance, and with the remaining 7,000 rupees, I buy 2 or other 3 shares. It is not a proper diversification. But when I'm investing via a mutual fund, when I'm even putting 10,000 rupees, it is getting divided in like 25, 30 companies, or maybe even more. That is the diversification that comes into picture, which is very important when it comes to investing. Secondly, the size is very small. The investment size is very small. So suppose again, say the Reliance share is at 3,000 rupees. I only have 1,000 rupees to invest, so I can't invest in a Reliance share. But with mutual fund, I can still get exposure to Reliance, of course, in a diversified manner. A very tiny portion will be allocated towards me, but I can do that.
Okay, so we've understood what are mutual funds, why they're good. Now let's talk about the different types of mutual funds. So Ankit, I want you to first talk about active funds versus index funds, and then we can go into the types of active funds. So index fund investing has become really popular, and this is like a kind of a trend sort of.
Okay, so first of all, a clarification. It's not active funds versus index funds. It is active funds versus passive funds. Okay, active fund means your portfolio manager is actively looking and researching what is a good company to buy, what price to buy at, what price to sell at. That is what an active management is, or an active fund is. Now, in terms of a passive fund, the entire portfolio is being replicated as an index, from an index. So Sensex is there, which has 30 companies, and if a Sensex index fund is there, by the way, an index fund is one of the most common way how you base a passive fund on, or passive investing strategy. And what it does is it tries to replicate an index. Whatever the name of the fund is, it will reflect which index it is replicating. So consider an index fund is there, which is working on or built on Sensex. Now, Sensex has 30 companies, Reliance, HDFC, TCS, these are the biggest companies in it. So say the weightage of Reliance is 5%. HDFC is also 5%, and TCS is also 5%. So this fund No matter how big or small the fund is, it will have 5% Reliance, 5% HDFC, 5% TCS, and say ITC is 4% in the index. This fund will also have 4% of ITC. They are not going to decide when to buy, when to sell. Whenever they have excess funds, when people like you and me, we are putting extra money, that entire money gets divided among these companies in the same proportion, in these 30 companies. And the only decision that is taken, when only the transaction that happens is when the buy or the sell is happening, that is dependent on the new money coming in. Okay, so if more money is coming in, it gets distributed accordingly, then the same proportion. If money is being taken out, again, it gets taken out in proportionate manner. So that is one reason why, when the buy or sell will happen. And secondly, when the index itself resets or rebalances. If a company is going out or a company is coming in, this generally happens in a roughly every 6 months. Most of the indices, rebalance their components every 6 months. So if the company is changing or the proportion, the weightage of them is changing in any of this.
So what is the benefit of passive investing? And especially because this is a beginner session. So, beginners, for beginners, passive investing or index funds do make sense. So if you want to just talk about
Actually, I won't say it do make sense for beginners. I mean, it makes sense only if you don't know how to pick a good mutual fund, good active mutual fund. If that can't happen, index fund is definitely something that you can get started with. The benefit of index fund is that there is no risk of underperformance over there, because it is just going to replicate the market. So whatever return, say, Sensex is giving, a Sensex index fund is going to give almost the same, minus just the tracking error or the fees that the company, that these professionals are going to charge. And of course, there's some small amount of tracking error. Tracking error is essentially because of the cash that they need to maintain to facilitate the buy and sell. And if you don't know where to pick it, you can just go ahead, buy a Sensex index fund or a Nifty 50 index fund, so that that particular task of finding a good mutual fund is also eliminated. Okay, so that is why it's just easier. Why it is becoming popular in India now is because, first of all, India picks a lot of things just from the US, and this has become very popular in the US market. Because it is low cost, because of course the portfolio manager is not doing much. They're not doing any research. They're not tracking the market closely. Okay, what is a good price to buy or sell it at? So it's like there's hardly any work that is involved. So of course they're not also charging anything. Now, this is a separate topic, but Indian market is not as mature as the US market, and what that means is that Indian market still has those hidden gems, those still opportunities that just the same weightage that is there in a index is not going to capture. Like, smaller companies are there, okay, which are growing at a rapid pace, but they are smaller. If they are smaller, Sensex is not going to factor in based on their growth. It is only going to capture how big you are. It doesn't capture in the growth. But if an active fund is there, if it is a good company, even say within Sensex, okay, so there are companies who rank 1 to 30. One is the biggest company, like say 5% share is there, and for the 38 there is only 2% weightage in it. Okay, so a Sensex or index fund will have 5% of the biggest one and 2% of the smallest one, but 2% company is growing really fast. There is nothing that the index fund can do. But an active management company, an actively managing fund, they can say, okay, I'll invest 5%, 7%, or whatever the limit is. They can go, okay, I'll be investing more money in the smaller company which is growing at a faster pace. Okay, this is the benefit that is there in an active fund, but you need to be careful in selection of that fund, because historically speaking, a large majority of actively managed funds have consistently not been able to outperform the market. So you need to be picky, and you need to be aware how to pick a good active fund.
Okay, if anyone has any questions, right, feel free to raise your hand, because we are just talking. But if not even just a question, even if you have any thoughts or you just want to add to what we are saying, feel free to raise your hand, and we'll get you into the conversation. Okay, so we talked about active funds and we talked about passive funds. Sorry, actually we just talked about passive funds, but let's now talk about active funds, right? What are the different types of active funds?
So active funds, just broadly based on the asset classes that just we talked about, they can give you exposure to these asset classes, and there are more specific type of funds. Say within equity, there will be certain characteristics that they will have. If they will only focus on biggest companies, or they are looking at smaller companies, or if they are looking across the size of the companies, or if they are focusing only on a sector, or they are focusing only on a geography. So in India also, if you want taking exposure to US market, you can do it through Indian mutual fund. Okay, or for that matter, China, or or other emerging markets. There are a number of such funds are there. So within equity, there are various options that you have, via mutual fund. Similarly, you have mutual funds that can help you invest in debt. Now, within debt, there can be various options: long term, short term, medium term, ultra short term. You can again select as per your the relevance. Gold is pretty standard, because in India as of now, through mutual fund you can only invest in gold as a commodity. ETFs enable you to invest in silver as well, but mutual funds directly don't allow you to do that. And then real estate is also there. So real estate has two paths, two actually paths how we can get exposure to. One is real estate mutual fund, wherein just works like a mutual fund company. You give them the money, and then they invest in real estate companies. Okay. Now the other option is investing in something called REITs. Again, slightly higher risk over there, and these companies, REITs, they are publicly traded, and they invest in properties, directly owning properties, and whatever cash flow, the rent that comes, it is distributed to you. So broadly speaking, these are the funds, how what the different kinds of funds, and within them how differentiation can be there.
Okay. So, as a beginner, would you suggest that I should try and understand how to select a good mutual fund, or should I just go ahead with, picking an index fund until I am able to, learn how things work, etc.?
See, as I mentioned, first of all, you need to understand what your needs are. If you're investing for relatively longer term, that is when you should be taking, some decent exposure in equity. If it is very short term, it's better not to go, invest in equity, because they are volatile. So risk is higher. It may be the case that you have invested 100 rupees today, and 2 weeks from now, the value of that is 98 rupees. Okay, it will, in the long run, it will give you good return. It is a growth asset. It will give you good return, but in the short run, it may not be very helpful for you.
So what you're saying is that before investing in like mutual fund or deciding active or passive, we should first understand the asset class. Like, should I invest in equity, debt, or gold? Is that right?
That's right.
And how do you, is there a structured way of following this कि कौन से में पैसा पहले लगाना चाहिए?
So first of all, you should be going for, particularly when you're building your portfolio, as I mentioned, your emergency fund should be there.
Yeah.
Right. After that, based on, as I was saying, based on your financial goal, if it is relatively longer term, you see, and based on your risk profile, you can see how much percentage you can allocate towards, equity. And of course, if you're not taking help of an advisor, you can just, see, okay, how much you're comfortable with taking, some risky asset, which is, equities are. And by risk here, I mean, you are investing in asset. This asset can go up or down in value. We are not saying that you have invested, say 5 lakh rupees and it will go to zero. It's not that. Even if a company fails completely, because you're investing via a mutual fund, your overall investment will not go to zero. Okay, so what the risk that I'm talking about here is variation in the price. It can go up and it can go down, and it will in equities particularly. Okay, so when you're investing, particularly when you're starting just afresh, start allocating small amount of money towards equity. And if you are a beginner doing it yourself, index funds are actually a good way to take exposure in, just to see okay, so if I've invested say 10,000 rupees, 20,000, 50,000, whatever you're comfortable with in an index fund, and watch it say every month or so, or whenever you feel like. Don't watch it very often, because that may just give you panic. So observe it and see how you are thinking and how you're feeling about it, because it's extremely important. No matter how much people say you should keep your emotions away and all those things are valid only on paper. We are humans, and emotions are a very integral part of us. So when we see that, we feel certain way, and many a times it forces us to take certain action. So don't watch your performance, particularly equity portfolio, very often if you are particularly new to it. And once you see even when the market is moving up or down, you're okay with it, you can comfortable seeing okay if it is in loss, because do understand from the date of your investment to say 6 months or 1 year, there is almost, I mean, I can almost guarantee that you will see losses occasionally, or losses as in again 100 rupees has become say 98 rupees. There will be times when you will see that the value of your investment has reduced in 6 to 12 months. Within 16 to 12 months you will see it. How you feel about it is extremely important. You need to be honest about it. If you're comfortable with it, okay, that is when you're ready to put more money towards equity. That is how you understand, and be honest. Don't try to replicate anyone else.
Yeah. And eventually you'll reach a point when if the market crashes, you'll be like, और पैसा लगाना है.
Exactly, and that is what the dream is. Like we 3 days back, on 4 days back, on 3rd of June, the market went up, but on 4th of June, when the election result was expected, market Sensex crashed 6,000 points, and I can very proudly say, most of our investors, most of our clients, they were like, Ankit, market has crashed. Where should we put more money?
Yeah.
They weren't panicking. Okay, how can I take money out?
Awesome. So, Ankit, because you're talking about risk, थोड़ा सा risk पे बात करते हैं, because people don't understand risk, and we've seen this time and again, right? So, not all mutual funds are the same, and if you're not comparing them correctly, you may be comparing an apple to an orange. So the thing is, let's understand risk, and let's understand how to compare mutual funds.
Sure. So actually, just some time back, like 2-3 weeks back, I was having a conversation with a client of mine, and a relatively senior gentleman. He's an NRI, and I was talking to him, and then he has invested in a mid cap fund some 5-6 years back, and he was seeing that he's making something like 20% return on them. So he was like, yeah, this seems like a very good return, and I'm like, look at the performance of it across the mid cap funds that are there, and then we saw that it is one of the worst performers in the market, in the category. Okay, and so I showed it to him, how we are looking at it, how is it that you should be comparing, and his response was, oh, I never actually thought about it, because we were thinking, anyways, it is giving us more return than fixed deposit of 7%, so it's better. Now thing is, you can't compare the return that a fixed deposit is making to the return that this mid cap fund is making, because the risk profile of these two investments are miles apart. First of all, one is a fixed income instrument. It is giving you guaranteed 7% or so return. With equities, there is no guarantee. Okay, so that difference is of course there. Okay, so you can't compare a fixed income return with a equity return. Secondly, when we are talking about mid cap, when we are talking about equity, within equities there are various categories of mutual funds. So the risk and return profile of a large cap mutual fund is going to be very different from a small cap mutual fund. Because when the companies are smaller, the risk goes up. You need to understand it very clearly, and when you're comparing the performance, risk has to be the same. So what that means is you can compare returns only in the same category of investment. Okay, this is on the equity side. Now let's talk about also about on the fixed income side. Talk about risk. See, when today market is like the interest rate on fixed deposit is generally pretty high now, but still, if you see, there are few funds who are giving close to 9% return, wherein banks like SBI, HDFC and all, they're giving you 7% return. Both are fixed deposit. Okay, why are they doing that? Think about it. Like a smaller bank, say Suryodaya Small Finance Bank, it is giving almost 8.6% return. Why is it giving that? Just think about it. If that company can raise funds, sufficient amount of funds at 7%, why will it give you 8% return or 8.5% return? The thing is, suppose today if I have 5 lakh rupees that I have decided that I'm putting in fixed deposit. First of all, we don't promote fixed deposit, but that's a separate conversation. But this is only for this example. Suppose I have decided, okay, due to some reason I want to put money in fixed deposit. I have 5 lakh rupees. if everything else is equal, like suppose HDFC is giving me 7% return and a Suroday small finance bank is giving me 7% return, where will I put money?
8%. So
No,
there's
no, both are giving 7% return.
Acha.
Okay, HDFC as well as Suroday small finance bank, both of them are giving me 7% return. Which one will I choose?
HDFC.
HDFC. Why is that? Because I know HDFC. It's a safe bank, it's a big bank, I'm aware of it, blah blah blah. Essentially, for the same return, I will prefer going for something which gives me lower risk, which is at a lower risk. And if Suryoday Finance Bank, small finance bank, tells me, ki, okay, why don't you put money here? I'm thinking, but why should I do that? I already have a relationship with bank. I know HDFC, I trust them. Why should I come to you? And that is when, this small bank says, ki, you know what? I'll give you 7.5% return. And I'm like, no, and you know what? Actually, it's not too much of a difference. I don't want to go move to you. Okay, how about 8%? How about 8.5%? And at some point is when people will be interested in, okay, you know what? This is a meaningful difference. And that is why I'll be willing to move to, putting money in this small finance bank. Okay, why? Because the risk is higher. The chances that HDFC will fail is very small. It's not zero. Nothing is zero. Nothing. No probability can be 0 or 100%, unless things have already happened. But probability of HDFC failing is very small. But the probability of a small finance bank failing is relatively higher. And only 5 lakh rupees, up to 5 lakh rupees of total investment. By the way, investment plus the total value. Okay, so whatever accumulated interest is there, that is protected by the government. If you're investing in any of these banks, putting money in any of these banks. Okay, so from that perspective, when you compare, even with fixed deposit, you need to understand that risks are different. That is why returns are also different.
Yeah, just because it's a fixed deposit doesn't mean it's safe.
Yeah,
right?
And it's completely wrong to compare return of a fixed income instrument like a fixed deposit to to an equity fund, whichever equity fund it is. You just can't compare these two because the risk return profile is very different.
Yeah. So when comparing returns, most people only look at the return. They don't look at the risk. Right?
Absolutely, yeah. So you can't do that. You can't think, okay, so I'm putting money, instead of putting 5 lakh rupees in fixed deposit, I can just put it in a small cap fund. No, you can't do that. The risk is very different. Of course, the return is going to be different, but it comes with its own set of risks. And you need to be aware what risks are involved. And if it is a conscious decision that you want to put that money in small cap fund, there's nothing wrong in it. But you should be aware what you're getting into.
Yeah. Which brings us to also the point that don't invest in anything you don't understand.
Oh, it's extremely important.
Yeah.
Invest only in things that you understand.
Yeah.
And do some research. There's so much of content that is available online. There is so much of content that we share in our community through our LinkedIn and as well as on our website. Resources sections are there. Resources section is there. Just feel free to explore. But just you also make sure that you are consuming information from reliable sources. Generally speaking, there are a lot of influencers that are there who talk about things wherein they don't even understand about that particular product very well, and they are promoting it. So if that is the case, you will see a sponsored written somewhere. If that is there, don't take that particular content for your knowledge purpose.
Yeah. And I also think maybe a lot of time influencers are not writing the content themselves. There's some junior person who's writing it because now they're too big to sit down and write content. So maybe that's the case. Anyways, now coming back to our conversation on mutual fund. Harsh has a question. Okay, Harsh, I'm going to Harsh, do you want to raise your hand again if you want me to? Okay. Hi, Harsh. How are you doing?
Afternoon, all well. I was just randomly looking at LinkedIn and saw this is happening. So glad I just stumbled across this. Quick question I had. I know it is not 100% related to mutual funds, but a very similar product, if you could shed light just from a difference POV, is small case, right? Like how are investing via mutual funds different from investing via something like small cases?
Yeah. Good question, sure. Harsh. Yeah. So for those of you who don't know, maybe just start by explaining small case and then, sure. Thanks for the question.
Sure. So, guys, first of all, small case is a basket of securities, basket of shares, wherein if you bought a subscription generally, you will be told about a list of list of shares that you can buy. Okay, you get to know about it. You can place the order as well, but you have to do it. You have to be actively involved. Okay, so this is a good time to invest, and whatever recommendations you have received, you have to actually go ahead and place the order for this entire basket. Put in whatever money you want to put in, and then you can invest. And again, after that, these individual shares are reflected in your demat account. And if you want to, whenever there is a notification that you should be selling this fund or that fund, or this share or that share, you have to do that yourself. And when it comes to shares, the prices can move relatively quickly. So when that suggestion has come, you have to act quickly. If you are someone I'm okay, so as I was mentioning earlier, like when you are investing in shares, there are two things that are needed. First is skill set, and second is time. Okay, if you don't have any of them, ideally you should be taking help from someone else. Now in this case, what Harsh has mentioned, small case subscription that you have taken, whichever subscription, if you think it is working well for you, you have taken that so that the skill set part is gone. You don't have to worry about doing that research, because someone else is doing that research. You are paying that person, and then you are getting this insight. Okay, these are the good shares to invest in. Okay, so that problem, the skill set problem, is solved, but the problem of time still remains. If you have the time, then you can choose to do that. Again, risk is something that is that can be relatively on the higher side. Again, depends the kind of small case basket you have selected. But this is going to be in the case only in equity. Small case, give you suggestions for investing in shares. Okay, and if you are okay with it, you can go ahead, do that. But again, the time problem is something that you need to still look at. When you have received that suggestion or advice, okay, this is something that you need to do, you need to be in a position wherein you are able to execute it quickly enough. But it can be a good product, again, depending on who the investor is.
Awesome, Harsh. Does that
And
answer?
so this is, and by the way, just to complete this, this in comparison to mutual fund is, in mutual fund, actually I'm transferring funds from my account to the mutual fund company's account. Okay, and they are not giving me any suggestion. They are taking that decision on their own at their end, and whatever money that I have transferred to them, my money that they have, they're just going to invest it, buy, sell whenever they want. There is hardly any involvement that is needed from my side after that.
Yeah.
Understood. So, is it like that I have more control over when I want to sell and if I want to sell, right?
That is the control that you have for both of them, Harsh. It's just that in mutual fund, when you're selling the a mutual fund, which is a portion of the entire basket. And with a small case, you do have the control if you want okay, so when they suggested and you bought say 10 shares, and you have much more control over it. If you just want to sell 2 of them off of the 10, there's no, you can definitely do that. No one can stop you. But what that also means is you do have the control, but it also introduces risk. How that basket was created and what was the importance of these 2 specific shares, you may not know. And if you have sold those, you don't know how the basket got impacted.
Makes sense. Thank you for this. Yeah, this answers. Thanks, Ankit. Thanks, Medha.
Sure, thanks for your
Harsh.
question.
And thank you for joining us. I'm going to move you to listening. And if you have another question, just raise your hand. Okay, we have another question from Divya. Divya is a member of our WhatsApp community. So Divya is saying that which platform should I use to invest in SIP, because I'm skeptical of new age finance apps after what happened with Paytm.
Okay, so this is a question that we get often, if this platform is safe or not, or that platform is safe or not. Thing is with the regulations that we have in the country, as long as it is a platform that is approved, that has proper licenses, you don't need to worry about any of these platforms, because the way it works is you are not giving them a single rupee from your account. The money gets transferred from your account to either Bombay Stock Exchange or New York National Stock Exchange, and from there it goes to the relevant mutual fund company, the AMC, Asset Management Company. Okay, these platforms are just for the purpose of convenience. Even if these fail, your money is still, all your investments are safe and secure. It's just the convenience is something that will take a hit. You'll have to do a little more. You'll have to put a little more effort to if you want to buy or sell. If suppose a platform through which you have been investing, it crashes or it just vanishes. Your fund, suppose I have invested in say SBI XYZ mutual fund or HDFC ABC mutual fund through this platform, these two funds I have invested in. Now what I'll have to do is I have to go to HDFC's website, HDFC mutual funds website, and then do the transaction there.
Yeah, so I think just to give a comparison, imagine that if tomorrow Google Pay fails, it doesn't matter because your money is still in your bank account. So that is just a platform through which a transaction is happening, right?
Very rightly said, Medha, yes.
So similarly, your mutual fund is safe. The platform is just something you use to make the transaction.
That's right.
Okay, Rajesh has a question. So, Rajesh, can you raise your hand again? Okay, perfect. Yeah. Hi Rajesh. You can unmute and speak.
Oh, yes. Hi, Medha. How are you?
Hi, I'm good. How are you?
I'm doing good. Hi, Ankit.
Hi, Rajesh.
Yes, when I joined in, I heard you talking about mutual funds. You mentioned about mutual funds in real estate.
That's right.
So, if you can throw some light on mutual funds in real estate, I've actually not heard about it. But if you can throw some light on that, will be helpful.
Sure. So, Rajesh, there are mutual funds that help you get exposure of the real estate industry. Okay, what these mutual funds generally do is that they are going to invest in companies that are involved in real estate related activities. So they can be builders that are building apartments or commercial buildings. They can be also involved in construction of some other assets, infrastructure kind of assets, like say roads and stuff. Like for example, L&T is a company that does a lot of that, right? They build commercial buildings, they build residential buildings, they build retail kind of building, like shopping malls and stuff, and they also build roads and bridges and whatnot. So these mutual funds, real estate mutual funds, are going to invest in such companies like L&T, Larsen. Okay, so that these are the kind of mutual fund. These are real estate mutual funds these are the places that they invest in. Now, apart from this, I also talked about REITs, REITs, Real Estate Investment Trust. So what they do is the money that an investor is putting there, again, as I mentioned, it is traded on the platform, on exchange. When you're buying the money that they have collected, it goes in actual projects, not in the companies. Suppose L&T has constructed an office building, they will buy the office building. And whatever rent is coming, that will come to the REIT, and then REIT is going to distribute it. I won't get into the more detail about how they actually function and their structure and how cash flow works and stuff. But broadly speaking, these are the two ways how exposure can be taken into real estate via managed service.
Yes. Thank you.
Sure, Rajesh.
Okay.
And by the way, Rajesh, there are other ways of getting exposure in real estate as well. Since we are covering mutual fund today, that is why we have not mentioned about others. But newer ways of investing in real estate is also coming. These are called fractional real estate. So there is a property, and you buy a piece of it through some structure. And that structure can be different. The kind of property that you can invest in, that differs from platform to platform and the company to company that you're using. But there are various ways you can get that exposure as well.
Right. Yes, this was really helpful. Yes, thank you so much, Ankit.
Thanks, Rajesh.
Okay. Great. We're going to kind of start wrapping up the session now because we're almost kind of hitting the 45-minute mark. I just wanted to talk about very quickly that if you're a beginner, one thing that you should also possibly consider is talking to a financial expert, Now the thing is that there are so many different types of financial experts in the market. So we wanted to do a quick rundown of what are the different types of financial experts and what are the pros and cons of each, so that if you're getting started and you want, okay, in the beginning I just want a little bit of hand holding and then I'm sorted, I know what to do, I can do it from then on, then how do you actually select a financial advisor, right? So Ankit, if you can walk us through the different types along with the advantage and disadvantage of each.
Sure. Actually, there was a great piece of content that was done by Mint, the media house. And I'll refer to that, and I'm going to ask Medha to share this one pager on the group as well, our FFC community, so that people can look at it and have that as a in their record. So first one is a real registered investment advisor. So they are someone who will just give you advice. They'll charge you a fees, okay, and they work only purely in your interest. Okay, that is how the structure is. There can be no ambiguity. Whether that person is good or not is something that you will have to select. But as per the regulation, they will be working in your interest. Okay, they charge you a fees for it. Now the problem over there is that the fees may be too high. Okay, and particularly for people who are just starting, that fee may be too expensive to afford. Okay, second is mutual fund distributors. These are the people who don't charge you anything. They get a fees from the mutual fund company, and when you are investing via them, when you're taking their advice, they're very accessible because they don't charge you any fees, and they also help people who are just starting off. Now the problem over there may be that the person who's advising you this particular whichever fund, how good or bad that fund is. Okay, because it may just be the case ki first of the two things. First is that person has not done their research properly, so they don't even know if this is actually a good fund or not. As I mentioned earlier, when it comes to actively managed mutual funds, research says that some 70-80% of the actively managed funds fail to consistently beat the market or beat the index. So this person needs to suggest you a fund which is actually good and which has sort of consistently been giving you better returns than the market. Because if that is not the case, why should you even bother investing in an active fund, right? You can just go to a passive fund, pay lesser fees and get the market return. You should be willing to pay higher fees only when you are expected to get better returns, right? Otherwise there is no point of investing in that. So that is one thing, whether this person is advising you a good fund or not. And secondly, that you need to be aware of is the commission, because commission is being paid by the mutual fund company to these guys. It may just be the case that this person is trying to sell you a fund which gives higher commission to them. Higher commission in itself is not bad, provided that you are able to get overall the net return that is coming to you is better. So that is something that you need to be careful about.
Okay, before you go ahead, I just wanted to say that we are mutual fund distributors. So basically,
Yes.
that is why Ankit took a little bit longer to explain that. So we also help people invest. We don't charge you anything. But in return, of course, we make sure that they're good funds and they make sense for you. And, essentially, net, it's like you're making better returns, right?
Absolutely.
Okay, next.
So, and that is how we are different from just about any mutual fund agent that is out there. And we are not looking to make just 2,000, 3,000, 5,000 rupees extra from a client, and then maybe when the person finds out that we suggested a bad fund, essentially that relationship ends and we disappear. What we are building is for next 50 plus years, and if we want to be in business for 50 plus years, it can be only done when we build that trust and when we suggest you good products. So we are very mindful about it. But of course, since we are talking about ourselves, you can always discount whatever we are saying and take your own judgment. I mean, on the call we have a few clients of ours. They already know how we advise them and how we are helping them in their experience. But yeah.
Okay.
So next one is research analyst. What they do is they do the research and they're going to tell you which is a good fund to invest in, or even which is a good stock to invest in. Okay, they charge you a fees for that, and that is where the relationship ends. So it's not a wholesome financial advisory. It is just, you can say, they'll tell you just their opinion about one particular security. They may say, okay, this is the best large cap mutual fund that you should be investing in. They'll charge you fees to tell you this, but that is what they will do. That is essentially the extent to which they will help you. Okay, so this one is like, of course, it is not the disadvantage is key. It's not customized for you.
They don't help you invest. They will
don't
not
help you
monitor
invest.
it.
They don't help you invest. They don't monitor you. They tell you, okay, this is a good fund to invest. Suppose they're saying, okay, this is a good share to invest in. Again, I'll take the name of Reliance because it's a very famous company. Everyone knows about them. They say, okay, so say 20. It's a very good company to invest in. You can buy it at a price that is lower than say 2,800. And when the price reaches 3,500, it can be a good price to sell. Now the problem is that it's not going to reach 3,500 overnight. It may take a year or so to say 1 to 2 years, 1.5 years to reach there, and you don't know if at that point of time if it is still a good company to invest in or not.
So you'll have to go back to them.
You'll have to go back to them and then ask for their opinion again. Okay, and which means, so of course you have to pay them again.
Right.
Okay. So that is what the situation over there is. Next one is portfolio management service. It's like you just give them the money to the portfolio manager, this portfolio management service company, and you don't have to worry about anything. They are going to take all the decision. They have full discretionary control. The thing over there is the minimum investment amount is 50 lakhs, and secondly, generally speaking, the fees is on the higher side. But that is something that you need to again look at. If if they're charging you higher fees, by the way, the fees gets deducted from the investment that you have made. You don't need to pay them separately. The fees that they are taking, are they able to generate a better return than that or not? Better return than market or not? Okay, so this is portfolio management service for you. And of course, the last one is you can do it yourself. But what you should be careful about is like where not to take advice from. Is just randomly taking it off the internet. Internet is great for the purpose of knowledge, provided you are consuming it from a good, reliable source. But as far as advice is concerned, it is best not to take it from there, and just be more conscious about it. We are going to share this one pager that Mint has done. It has a few other points about where not to take advice from, something that I wouldn't like to mention on my own here, but I'll share that document so you can look at that.
Okay, another thing I wanted to talk about is that, of course, in a country like India, there are all kinds of people giving advice. So even when it comes to, whether it's RIAs, registered investment advisors, or mutual fund distributors like us, how do you spot a bad advisor, right? So again, if you're a beginner and doesn't know a lot, how do you actually know that this advisor is not, kind of invested in your best interest? So the first thing is anyone who's creating a lot of urgency, right? Ki like abhi kar lo, market aisi hai. Like we always say that you should not invest in FOMO. So you should not be having this fear of missing out. If someone is creating FOMO, creating unnecessary urgency, something is an actual urgency, right? Like when Ankit said on the 4th of June when the markets crashed, that was an actual urgency because it was a great,
urgency as in it was a good opportunity to make use of. There were few clients of us, a lot of clients of us who invested, and then there were few who were not able to invest. This is an opportunity. If you're able to make use of it, good for you. If not, there will other opportunities that will come in the future.
Yeah, but not creating unnecessary stress or urgency. Anyone who promises you any kind of guaranteed return is a bad investment advisor, because even like when people talk to us, I can't guarantee you a return. I can give you maybe a bracket based on your risk profile and where you're investing, but I can't guarantee a return. People who use a lot of jargon, so people using complex words, trying to confuse you. So this happened to me, right? Like I had gone to a bank and, they were telling me that I should invest my money. And I was just kind of listening to him because I wanted to hear his sales pitch. So I was like listening, and he's explaining things to me and promising returns and all of that, and using a lot of complex words that I didn't understand. And in fact, when I asked him to clarify it, he wasn't able to explain it to me. A good financial advisor should be able to explain something to you as if it is to a 5-year-old. Like in a very, very simple way. And we all know, right? When you understand something clearly, you're able to explain it clearly as well. The next is people who like randomly call you, right? So this is something we've all experienced now, like loan le lo, credit card le lo, ye le lo, whatever. So generally also with the number of scams that are going on in the country, just being aware about not just listening to anyone who's giving you a call, generally a good practice, not just for investment advice.
Yeah, and another thing to add here, when you get those calls from your bank relationship manager, ki sir or ma'am, this is good time to invest, something new has come up, and then when you say okay, you will take time, you'll say ki sir please invest kar do na, it's like ki matlab, quarter is ending, I have to meet my target and stuff. You shouldn't invest your money so that someone else can meet their target.
Yeah.
You should be investing money only because it makes sense for you to invest money. Be very careful about it, because this is something that I personally have faced a number of times. I have a banking relationship with two pretty big banks, and the relationship managers, occasionally they have called me ki sir yahan invest kar do, wahan invest kar do, because I need to meet my target. Okay, that is not how you should be investing your money.
Yeah. And finally, what are the kind of questions you should be asking, right? So I've identified a good investment advisor, but of course I need to ask certain questions to understand whether they're good or not. So what are some of these questions?
And actually, before you get into that, what specifically questions to ask, if it is the case that when you start asking questions, if this particular advisor starts getting impatient or trying to just dodge the question कि हाँ sir ठीक है आप खुद पढ़ लो यहाँ लिखा हुआ है, ठीक है, if I have to read that, why are you the advisor?
Yeah.
If I want to read more, sure I will read more, but when I'm asking you to explain it to me, you better explain it to me, na? You are the advisor, that is why I'm asking you.
Yeah. So when it comes to questions that you should be looking at, first is really look at their background. Okay, like there are so many people that have investment banker, some analyst on their LinkedIn profile, and we all know LinkedIn profile, right? Everyone's a top voice, everyone is like has major achievements in life, and we're all like just trying to put our best faces out there, but really understand what is their background, what is their specialization, what is their level of experience.
So actually on this one I just want to mention that I came across a finfluencer, relatively big one, who mentions that she is a investment banker, and when I checked her profile, it said that she worked for something like 2 to 3 months in some investment banking firm in a small city in Gujarat. Investment banking in India generally happens in Mumbai, primarily in Mumbai, and then up to some extent in Bangalore and Delhi. And even if you have worked for the best investment bank for 1.5 months, it doesn't add much, but it's a good thing to say, to attract attention.
So just like try to see whether what they're saying, their qualifications match up or not. The next is try to understand their investment philosophy, right? Like how do they manage money? How do they, what kind of support can you expect from them? How are they making money? How will they make money for you? Can they provide you with references or like other people who they have helped? If they have testimonials, reviews, which we anyways always check, but we should definitely ask, and you should not be like afraid or like shy about asking for them. So just be very confident. This person is going to be managing your money, so make sure that you're very confident in asking, hey, can you give me references? How will you create the financial plan? How are you going to monitor it? All of those questions you should definitely be asking. And like Ankit said, if they're not answering them, they're dodging it, then you also know that's a red flag.
Absolutely.
Okay.
So we'll be sharing these two, one page document.
And the mutual fund cheat sheet.
Yeah, actually the mutual fund cheat sheet in our community. So everyone who is a part of the community, you'll be receiving that so that you have it for your record.
Yep, and anyone else who wants to join our community, if you head over to Ankit or my LinkedIn profiles, you can just click on the link and there's a form, you can fill it and we will add you. So yeah, I think that's about it for today's session. I think we've covered all the points. In case anyone has any last questions, we're happy to take them. Anyone? Yes. Sahil has a question. I'm allowing you to speak. Hi Sahil, good afternoon.
Good afternoon. Hi Medha. Hi Ankit. glad to connect. And I think for everyone else, I'm one of the clients. I just recently started working with them. And just one thing, Ankit, I want to know. You mentioned that we should be aware, we should have some knowledge about all these investments that we're doing. But now that we're working with experts like you and Medha, how much should we be involved in all of this? Like, I just don't I have 99 problems in my life. I don't want this to be one of them. So how much do you feel we should be aware of what's going on?
Okay, so Sahil,
I'm just gonna. Can you mute yourself, Sahil?
Yeah, sure.
Thank you, and thanks for the question.
thanks for the question, Sahil, and thank you so much for just saying that you are a client, because I or we can't call people out ki you are anyone is our client. So thanks for mentioning that. So Sahil, the service that we are providing, the purpose of this is so that you don't have to get involved too much. But when we were saying initially, when we were mentioning ki you should ask questions ki about what is it that you're going to do and stuff, this is at the stage wherein you are evaluating whether this person, this advisor is right for you or not. That is when you should be doing a lot of your research, okay, and a lot of the questions. And like for John example, you came via referral. So the person who referred to you, he has been our client for a very long time, and you trust that person, and that person trusts us, and that is why you came to us. So there was some level of inherent or initial trust that was already there between you and us. But still, when you're going there, if you have any questions, you should definitely ask. Like I remember, Sahil, in your case, you did ask ChatGPT to, keyword questions to ask your financial advisor when you're talking to them. Do your research wherever you think you can get information from or questions from. You should ask them, and more importantly, as I mentioned, even if you don't know the answers or you don't have that skill set or background, what is very important is to understand that the attitude with which the person is answering you, if you just started asking questions, is it right or not? If it is like the person is just dodging questions, not even willing to answer, that's not right.
And I think once you become a client, then anyways you have reviews with Ankit, right? So he'll do your general, like when it's time to rebalance your portfolio, you'll have your times, and for us we're also having our investor meets. So at various times you'll be invited online, and we'll tell you, okay, what are we thinking about the next quarter. In fact, an investor meet is just about around the corner. We're going to share the date soon. So in those meets are great times for you to ask those questions, understand what is happening. So essentially why we are here is because you don't have to be involved on a day-to-day basis.
Yeah, but if you have read anything anywhere, if you come across something, and if you have questions, okay, so I read something from someone relevant, and you want to understand how it impacts your portfolio, okay, feel free to reach out.
Yeah.
I mean, I'm not just saying for us, to us. I'm just saying to everyone else, whoever is advising you, reach out to them. Okay, this is what my question is. This is what I thought, and don't think that your question is stupid.
Yeah, and you can also put it in the community.
No, I'm not saying just for WealthUp. For everyone, whoever you are taking the help from, ask that person, okay, this is my question. How is it going to impact my finances or my portfolio? Mm-hmm. And that person has the responsibility of responding to you.
Yeah.
Got it, Ankit. Thank you so much. Just like one example I had was, on the 3rd of June when, you just messaged that this has happened and everything. And I just, I didn't even look. I just whatever you said, I just did it. I just want to be aware of what I'm doing. So maybe that, we can connect later or whatever.
Oh, absolutely.
How do we kind of know what's happening? Yeah.
Yes. Absolutely, Sahil. See, the thing is ki on that particular day, it was such an opportunity to just capture with limited time, that we had to be okay. Like first of all, I mean, particularly for people, we reached out to all our clients. We told them exactly what to do, and of course, most of our clients executed it. They were also able to execute because there were certain technical glitches on Bombay Stock Exchange and stuff, wherein the orders people were not able to log in and place the orders. But definitely you are entitled to know what is it that is happening, and we will connect offline to answer any questions you have.
Yeah.
Definitely. Thank you so much. Yeah. Appreciate it.
It was just that in that moment I did not have time to explain it to everyone because
I'm not complaining or anything. Just that I would from my end would want to be aware, like what exactly is happening. Why did we do that day?
Sure.
Like, just want to be aware of that. Like, not from your end. Like, I would be. Yeah, that's
Sure. So, but just to tell you very briefly, Sahil, the investment that you did that day, like three days back, the market was down. That is why you bought it, because it was coming at a cheaper rate. You bought it, and you are already sitting at a profit of around 5% in 3 days on that investment.
Wow, that's good news.
Okay,
Thank you
so that is what
Yeah.
so that is why, because it was such a huge opportunity now, because those such days are rare, and a crash like that happened 4 years back when COVID happened. So when that opportunity was presented, I was rushing so that all my clients are able to invest their money in that crash or correction, so that they can benefit from that.
Got it.
But we
Understood.
will-
Yeah,
we
let's
will
connect
cover
later.
it.
But yeah, I appreciate it.
But we will cover it for you specifically. We will, I'll get back to you. I'll connect with you over WhatsApp. And as Medha mentioned, we have a investor meet coming up. So all our clients, we'll be inviting them for a conversation. Whatever questions you may have, you can ask us.
Yeah.
Sure. Done. Thanks.
Awesome. Thank you, Sahil. Moving you back to listening. So yes, that brings us to the end. We've kind of overshot time, but that was like a really lovely chat with all of the people who asked questions and stuff. Thank you so much for joining us on a Saturday morning. We do this every week on Saturday. If you follow Ankit on LinkedIn, you can get the updates on when the next events are happening. So yeah, thank you so much for sticking around, and we'll see you next week. Thanks everyone. Bye-bye. Have a wonderful weekend.
Thank you, guys.